Hello and welcome to Rajya Sabha Television. You are watching Big Picture and I am Vishal Dhiya. Now today we're going to talk about RBI's monetary policy review. In the review which has been done on Friday, the Reserve Bank of India has left interest rates unchanged for the fourth time in a row. Now repo rate is kept unchanged at 4% and the reverse repo rate at 3.35%. The projection for CPI inflation has been revised to 5.2% in the fourth quarter of 2020-21 and 5.2% to 5.0% in the first quarter and 4.3% in the third quarter. Now, GDP growth is projected at 10.5% in the range of 26.2 to 8.3% in H1 and 6% in Q3, that's third quarter. We'll try and understand all these figures and we'll also try and analyze as to what exactly does this mean in terms of the RBI deciding not to bring any change in the rates out there for the fourth time in a row. And for more on this, we're joined by a distinguished panel of guests. Let me first introduce them to you, beginning with Mr. Ashok Kumar Jha, former Secretary, Ministry of Finance, Government of India, is joining us. We also have with us Professor Aman Agarwal, Director, Indian Institute of Finance, and Mr. A.K. Bhattacharya, Editorial Director of Business Standard, is also with us. Welcome, all of you gentlemen, to Rajya Sabha Television. Let me begin with you, Mr. A.K. Bhattacharya. Let's start by putting these numbers in perspective for our viewers, given what exactly the situation is, and also the fact that RBI for the fourth time consecutively have decided not to touch the rates there, interest rates.
Well, I think it is very clear from what the RBI Governor, Mr. Shaktikant Das, said in his statement that the availability of money should not be an issue. And therefore, inflation assessment on his part will remain, and inflation will remain benign. So keeping those two things in mind, he has kept the stance of the Reserve Bank of India's monetary policy, which is largely composed of what kind of interest rates or the cost of money that should be in operation. So on the whole, it's a policy of continuation. But I think the real implication of this policy is not in what it has done by way of rates, but by what it has done outside the rates. Okay. I think it has addressed the critical question of a Government of India's borrowing of 12 lakh crore next year with a novel scheme by which retail investors can tap into the government bond market. Now, earlier, these schemes were announced through indirect methods, but now India joins countries like the UK, Brazil, or Hungary to have a direct route for retail investors to tap into the government bond market. This is essentially aimed at making sure that the government's borrowing program does not face any hiccups or any hurdles, because 12 lakh crore in a year of recovery could be a problem, even though there is liquidity is not an issue. Around 6.5 lakh crore of liquidity surplus is in the system. Nevertheless, the RBI has taken an advanced set of measures. One, by allowing retail investors to get into the government bond market. One has to see the details of it. And the second decision is to allow banks to keep their bonds, the government bonds, under the held to maturity segment. In other words, that they don't have to report the mark-to-market losses every quarter end, depending on the fluctuations in the bond prices. Now, this is what the banks were slightly worried. Therefore, the attractiveness of government's borrowing, attractiveness of the government bonds have been kept intact. And even though the CRR rates are going to be raised over a period of time, but I think the entire policy has to be seen from the way it has tried to manage the government's borrowing program without much of a hiccup in the bond market. In spite of that, please note that the moment the RBI governor did not announce any open market operations and the policy, the bond market especially for the government bonds, the actual yields went up by around 10 basis points. But my sense is that once this retail access to the government bonds, GSECs, as they say, is allowed, and the people in general can access those bonds and trade in them, that happens, that I have a feeling that the government borrowing program will not be that big, such a big issue for the market. Rather, taken together with the retail access to the bonds and the held to maturity segment facility being extended for banks for bonds, I have a feeling that this huge burden of higher borrowing, that challenge has been met and will be met. Let us see how these schemes are rolled out and how the market behaves in the coming days.
Okay, definitely. We'll have to wait for the final details out there, as Mr. Bhattacharya is pointing out. Let me also bring in Professor Aman Agarwal here. Professor Agarwal, from your point of view, these aspects vis-a-vis the monetary policy, not only keeping the rate unchanged, but as Mr. Bhattacharya is pointing out, the retail investor being allowed there in terms of the government bonds, government securities, that particular section vis-a-vis the government borrowing. How do you think this will all play out?
No, I think the first part, which is the unchange of the rates, is very critical because it is important to bring about a stable policy, given the framework that credit offtake still needs to take place and the economy is expected to get into a rebounding phase in this quarter and the next, given that the vaccine is out. So the fear factor in the people will reduce and they would like to get back to business and a more active role as against what they were in the past. So given that the credit offtake is expected to take place if the rates kept on low, and I think that is one of the important components. Also, the fact randomly changing rate policies, it becomes complicated not only for banks, but even in terms of the investors looking at it from a long-term perspective. So from that perspective as well, it is important that the RBI has taken a good decision of not changing the rates. This also shows that we are actually bottoming off in terms of rate reductions, and whatever will happen in future is going to go up. And that is what Shaktikant also said, that we're looking at an upward trend upside as a last comment towards his speech. Now, as far as the bonds are concerned, the 12 lakh crore, which is expected to be raised, certainly world over, people in large have more confidence in the central bank than the government per se, because the government bonds can be liquidated through seniorage money, which is not normally done by the central banks, and they are well managed and have better positions. And that's where I think this particular framework which is being talked about is a better stand. People do have the liquidity in terms of parking, and I think raising this money would not be a difficulty, given that people are not investing extensively in other assets like the real estate or the gold, which they have been doing in the past. So they are looking at a stable investment avenue. A lot of people are also looking at avenues where they can actually go about. And fortunately, the RBI has allowed the retail investor to directly now log in, which was not the case earlier. And I think that gives a better edge. More than that, I also see the fact that this policy brings in the framework of growth component. The RBI is generally considered to be conservative in nature, and the fact that they have given out a 10.5% growth rate at the backdrop of inflation under control, because if you look at the economic survey figures, even the budget, it was projected at around 6% and above as the inflation. So they have been able to bring it down to 5.4% as corrected figures, and then it is expected to go down to around between 5 to 5.5%, which is fairly a good, comfortable rate given the kind of scenario and the kind of fiscal spending of about 9.5% or so, which has been projected in the union budget as has happened in the last 1 year. And I think given that the control of inflation with component, because both of them move opposite in direction, I think which the RBI has brought up.
Okay, definitely. That inflation part is also really important. We'll go to that as well. But let me first bring in Mr. Ashok Kumar Jha here as well, former Secretary, Ministry of Finance. Mr. Jha, the question here is that, the kind of monetary policy which has come out, how is it going to help the government specifically in a very crucial period as we stand now? We're trying to, come out of the shock of the COVID pandemic. Vis-a-vis the economic situation. So how do you think, after the announcements which were made in the budget, based on that, these policy, how does it complement that?
Yeah, actually, this policy of the RBI fits in very well with the budget projections that were made by the finance minister recently. In fact, the budget itself was focusing on growth, and this RBI policy will help in furthering that objective. See, by keeping the rates as they were unchanged, that is 4% repo rate, it gives a clear signal to borrowers that they can continue to borrow at a low rate. And this in particular will help sectors like, say, the real estate or even the auto sector. See, in the auto sector today, most of the purchases are made by taking loans, and therefore, the cheaper the rate, the better it is for that sector. And similar is the case with the real estate sector. Mm-hmm. In addition to this, I think the fact that the RBI has also decided to allow banks to extend credit to NBFCs under the targeted long-term operation scheme will ensure that banks are able to lend to NBFCs in a much more orderly fashion. Furthermore, I think they have got a new scheme that they've introduced to provide incentive to banks to lend money to MSMEs. See, those MSMEs which have not taken any loans up to 1st January 2021, there is a scheme that they have provided in this policy by which banks can extend credit to these MSMEs without that being counted towards their CRR. So this is all basically going to help the borrowers to access money to be able to further the objectives of growth of the economy.
Okay, so credit flow is something which is really important, as Mr. Jha is pointing out. That is where the focus of monetary policy also seems to be. Mr. Bhattacharya, I'd like to bring you in here again, and then this time around on two aspects, that is the projections of the inflation as well as the GDP, as Professor Agarwal was also pointing. How do you think these projections are going to play out, and are these numbers achievable as well, given the kind of policy vis-a-vis not only the monetary policy, but what we saw in budget as well, and the difficult times we are trading right now?
Yeah, important questions you have raised, Mr. Dhiya. I think Reserve Bank of India governor on the question of inflation is pretty realistic. He actually, there was a time when the Reserve Bank of India was a little worried about the inflation trajectory going a little out of control. As a matter of fact, you would have noted that almost for 6 or 7 consecutive months, the inflation rate was above the upper tolerance band of 6%. And the Reserve Bank of India was really worried. And there was this question that whether under the monetary policy inflation targeting regime, should the RBI now make a statement to the government of India under the inflation targeting regime that this is the reason why inflation is not gaining under control. But it's clear that in the last couple of months, the inflation has cooled down a bit. In a sense that the winter months are here with us. So they've seen a deceleration in the inflation rate. And also going by the projection that the RBI has made, the inflation will remain within the band of 2% and 6% side. So that, to my mind, is also a confirmation of the Reserve Bank of India's inflation targeting regime, and probably a proof that the inflation targeting regime that was started in 2016 has really served its cause. And as you know, that from 2021 March, a new regime would be put in place. And if you look at the Reserve Bank of India governor's statement on this, you realize that there is also that expectation of continuity of a similar inflation rate targeting regime, which is also a good thing. Just as some other fellow panelists said, that there are advantages of continuity in policy. There are advantages if the inflation regime, the targets, they also remain stable and they are within those expected norms.
Okay.
So that is about inflation. Now, coming to GDP, in my view, that this is probably the first time in recent years that the RBI has been, little more, I would say, optimistic than the government itself. I mean, if you have noticed that the RBI's projection of a contraction in the current economy was 7.5%, but the government's estimate of National Statistical Office and NSO data was 7.7%, which was slightly worse than what the RBI said. But in this time, the RBI is talking about a 10.5% growth, whereas the government's or the economic survey's projection is 11%. Okay. So I don't think that achieving an 11% or 10.5% real growth the next financial year will be a tough task at all, because after all, the economy is on an upswing. It is seeing a recovery after seeing the kind of contraction that we saw in the first and the second quarters of the current financial year. So I don't see any problem. The real challenge of growth would be from year 2022-23. So for next years, I don't see either on the inflation front or on the growth front, there are many doubts on achieving those targets or projections.
Okay. Let's also hear Professor Aman Agarwal there on these two aspects: assessment of growth and inflation. There, do you agree with what Mr. Bhattacharya is saying, that it's completely achievable, and these are good projections given the fact that the economy is finally on the upswing there?
Yes, I think they are fairly conservative projections, in my opinion. India, given its strength and the fact that we have in place two major vaccines, which can be supplied to a large chunk of the world, which can not only afford it, but can also contain it given the temperature levels it is within, where some of the big company vaccines are not able to do coming from the West. We have the potential to export it extensively and also gain a better equity in the minds of people at large around the globe, which will actually build on the equity of this country and ultimately lead to more prosperity in terms of exports also, which takes place from this country. Now, that is one component which we can base ourselves on. The other component which we see in terms of growth is the impetus we are expected to get from the different sectors of the industry, which have not been performing but have certainly given a rebounding factor in the last 4 or 5 months, leading to a GST revolutionary collection of something almost about what we had, more than what we had about a year back. Now, that is something which is also rebounding, which is not being calibrated and cashed upon in terms of the GDP numbers. Thirdly, the base has been low last year, and as a result, we are seeing that double-digit growth. So, there is if you really look at the potential of the country and the way we can go about doing it, both in terms of creation of job, in terms of employment, and the growth figures, we have much higher potential to go almost to the tune of about 15 to 16%. Keeping in mind the fact that in India, we have a parallel economy, which is almost as strong as the normal economy. So, that gives an indirect impetus to the economic frameworks as well. Now, not everything is illegal or money laundered, but there are large chunks which actually factor into the real economic framework, like the unorganized market and all. So that again is not. Now, on the inflation front, I am still a little conserved on the fact that it will be, the RBI is on a good trajectory. They're trying to contain it, and I hope they will be able to contain it to the level of around 4% in about a year's time. But the fact, the kind of problems which are getting up, and if the liquidity enhances as they want it to be enhancing from the banking sector, then it might be a case that the inflation might again see a little push upwards, which would be a little difficult for the RBI, and that is what they need to keep a watch on. My major concern as of today, apart from these two, is the fact that the RBI and the regulators and the bank is trying to push in more liquidity, but at the bank level, at the lowest level in the bank, they are actually trying to not go about giving loans to whether it is MSMEs or others, and that is at the bank manager levels. In fact, on the other side, this NPA regime, which the banks had come out, the RBI had come out with a notification for the OD accounts and the current accounts, there, unfortunately, some of the banks are trying to create a restriction in terms of all those who are holding OD accounts less than even 5 crores, or asking them to close the current accounts. Now, if that kind of a thing happens, which is not there in the circular, then there may be a hampering of the business. And that is where operational aspect is something which I'm more worried with as of today in terms of the market operations than the framework and the way RBI has been working. Lastly, I would like to say I'm very happy that the governor has clarified that it is not the bad banks. It is an asset liability management company which they're talking about. Because at your channel, at Lok Sabha TV, and even at All India Radio, have said in the last 10 years that bad bank as such, as a concept, has failed. It was there in the United States and a couple of other countries. It completely was a disaster. And so we should have an asset liability management company and not a bad bank. And I'm happy that the government has considered to introduce an asset liability management company and not a bad bank as such, which is important in terms of revolutionizing the bad loans which have got created over the last 10, 15 years.
Okay, definitely. That is something which has been done by the government, announced in the budget as well. Let's take a quick concluding comment from Mr. Jha as well on the inflation and growth aspects there, the projections which are there, Mr. Jha.
See, I think the growth projections that have been made by RBI are more conservative than the projections by bodies such as the government or even what the IMF had recently come out with. In fact, the IMF projection was 11.5%, the government's projection is 11%, and RBI is 10.5%. So it is RBI's projection is the least of these three. Now, I don't think there will be any problem in attaining that level, especially since the base year, that is 2021, is going to be a contraction of 7.5% or thereabouts. So there is no real issue as far as this growth of 10.5% is concerned. As far as inflation is concerned, I am a little doubtful whether the inflation, which for most of the year of calendar year 2020 was running above the targeted rate of 6%, maximum targeted rate of 6%. And of course, RBI has said that it will come down in the first half of next year. Basically because when there are so many pressures to go in for quick growth, there is going to be ample liquidity in the system. The entire sector, the entire economy has been starved of growth for almost a full year. I am not too sure whether this 5% will be achieved. It will probably be 6% plus.
Yeah. Okay, definitely. That is one area which we will also watch out for there. Thank you so much, Mr. Ashok Kumar Jha, Professor Aman Agarwal, as well as Mr. Bhattacharya for sharing your views with our viewers here on this very important aspect that is RBI's monetary policy. As our panelists were pointing out, consistency in policy is something which is very, very important, and that is something which looks like has been done by the RBI as well by not changing the rates, but in terms of the projections for inflation and GDP, as our panelists were saying, quite achievable given the fact that the economy is on the rebound. Inflation, though, might be a cause of concern, but we'll keep a watch on that as well, and we'll bring you all the details. Keep watching Ajya Television.